Howdy, Jacob here. Today we're looking at BlackRock. They are capital markets. They're in the capital markets industry. 118.7 billion market cap on 117.5 billion enterprise value. So good to see that net debt is negative, meaning they have more cash on hand than debt. They are very heavily involved in the real estate market. I don't remember where I heard it. I don't know the exact percent, but they own some stupid amount of homes in the United States and really globally. Um, we see that revenue is lackluster the last 2 years, but a little bit ahead of inflation the last 10 years. And gross margin down, operating margin down. That's tough to see. Earnings per share is huge. Dividend is also pretty big, but paying out a little over 50% of their earnings. We'll see what that is in relation to free cash flow. Return on invested capital is incredibly consistent. We're looking at essentially 9 to 13%, very consistent, very solid, very likely above their weighted average cost of capital. So they're increasing business, which is awesome. 8.718. So you're looking at about 10.5 billion cash on hand with 7.9 billion in long-term debt. A little bit of capital lease as well. So that $8 billion they can pay off with their cash. We're not concerned about the balance sheet. It is in the capital markets, so there's a lot of interesting stuff. We see 59, $60 billion in other, 15 billion in goodwill, 18 billion intangible debt, 65 others. So I definitely want to dig further into those and see exactly what those are. Balance sheet, or I guess I was just on the balance sheet. Let's go to the free cash flow statement. CapEx is pretty small. It doesn't take a lot to run the business, and their free cash flow, cash from operations, is definitely growing. Use of cash, the dividend, like we saw on the earnings side, it's a very similar story. You're looking at about 70% of free cash flow going towards that dividend. It is a 2.5% yield, but that doesn't leave a whole lot of opportunity to make acquisitions, buy back stupidly cheap shares, make acquisitions that make sense. So if we do look at their capital allocation, with 70% going towards dividends, they have issued a little bit of debt the last couple of years to be able to fund share repurchases, acquisitions, and then a little bit on the reinvestment side, maybe 10 to 20%, 10 to 15% on in reinvestment. So let's start making some assumptions here. They have a lot of debt. They have a lot of cash on hand. So with the debt figure, I'm not too concerned about that. So we have 100% of capital allocation to work with. I don't want them increasing this dividend because I want that to dwindle down to maybe 50% to keep opportunities open. I think that there's still a lot of investment acquisition, share repurchase opportunities that make more sense um, than paying a dividend. So to me, revenue growth side, I think they'll grow above inflation. I think they're essentially a market average company, so I'll give them a 15 on the PE side, maybe 16. So that's on the average is 15 to 16, so really 16 is still pretty average. And then margins are great. I don't like that free cash flow is a little bit lower, but I'm not too worried about that. Share change, so buy back a little bit of shares here. Let's say 1%, so that's about 1.2 million. Yeah, that's 1%. Stock-based compensation, you're looking at 1.8 million. So maybe just 0.5%. This is saying by the end of 7 years, maybe 50% of their dividend, maybe 25% to share repurchases, and then the rest reinvestment and acquisition to get a 4% return a year in revenue, and then 30 and 25 on the margin side. Oh, that is not right. There we go, 0.5%. With these assumptions, we're saying the company's stock price needs to fall 56% before you get the return looking for here. I think that seems pretty reasonable to me. I mean, stocks fall 50%, or stock variation is 30 to 50% in a year pretty normally. So it's not too far off. And again, there's so many companies. I don't just want to buy every company out there, even if it's a fantastic company. I want to wait until it gets to a price that makes sense for me in my position or for you in your position. You don't just want to buy everything so you can say you're diversified, whatever the crap that is. You want to buy things that make sense to you, especially if you're buying individual stocks. I mean, if you're not, just buy the S&P 500, small cap, mid cap, international, whatever. But if you want to get into individual stocks, you want to buy companies that make sense to you and are at the right price. And for me, given my assumptions, I just don't think that we're quite there yet. But as always, I hope you enjoy the video and have a great rest of your day.